What's up and welcome to episode 3 in the 6-figure series. So we just finished up with London just a little while ago and now we're trying to film this video. So we're going to be talking about a few different things. I've learned a lot of different lessons from the funding process so far and I wanted to share that with you, and there's a few other things similar to that I thought we could talk about as well. So without further ado, let's get into it. So for this lesson, I wanted to hop onto the charts and really show you visually what I mean and a clear representation of this. So this has been one of the fundamental shifts and lessons that I've really had to double down on throughout this whole funding process. And it's something that I already knew, something that I already applied to a certain extent. And I'm quite lucky in the respect that I've had this lesson drilled into me since becoming a trader from the early stages. So very grateful for my foundation, and that lesson is risk management. We're going to go into a little bit more detail than what you probably heard of before though, likely. So it's going to be good. But like I said, I'm very grateful for my foundation because I was taught good risk management from the very beginning stages, and that served me very, very well for the rest of my journey. And still, I'm on that journey with you. We're all just at different stages of the journey. So without further ado, let's get into this lesson. So from the funding process, this has got to be one of the most crucial lessons that has cropped up time and time again. Not so much of, just risking a set amount. So there's different aspects of risk management which we're going to go into. So the first one will be, these are 3 points just off the top of my head, but of course there is more detail that can be added here. But we have position size. So this is, lots, dollar, pounds, yen amounts, etc. So are you willing to risk 0.25% of your account per trade? Are you willing to risk 0.5, 1%, 2%, 3%? Plus, I personally wouldn't go anything above 2-3% in my opinion, but that's just my personal preference. That would be number one. Number two will be stop size, which is obviously relevant to the position size. So if you have a 30 pip stop, you're going to work out what 1% of your capital is, 0.5% of your capital is, to then figure out, your enter a position. Finally, number three is trade management, and this comes in both aspects of, when people think of managing trades, they think, winners, how do you manage winning trades? But there's also both aspects. You have to learn to manage winning trades and to manage losing trades effectively. So the summary of this is that I was reading a book, it's called Unknown Market Wizards. And if you haven't heard of it, I definitely recommend checking it out. There's some really great interviews in there. And these are unknown traders for a reason, so you may not have heard of them before. But there's one interview that kind of sparked interest and thought in me more than the others. And I've heard of this principle before, but this kind of cemented it even further. So it's an interview from Peter Brandt. Now I won't tell the whole story because it's important that you go through the book yourself and figure out what gems you get from that book. But, one of the most important things he said is that he manages risk very effectively. So I don't know his trading style that well, but I can assume that he's taking quite a few break-evens, but he's minimizing the downside. He's protecting his capital, which is one of the most important things in my opinion. If you can protect your mental and physical capital in trading, that is the most important thing, because a lot of people think of capital in terms of dollar amounts, pounds, dollars, yens, that either winning or losing trade. But the truth is that you also have mental capital, you have to think about your mental state of well-being when you take trades and how you manage trades. So that comes into the equation here as well. So my question to you is, let's say so this isn't the style that I trade, by the way. I just wanted to kind of relate to a lot of you because I understand that there will be a lot of you guys watching this that will trade a similar style to this. Maybe support resistance, maybe patterns, trend lines, indicators. So what I've done is just placed a few key support resistance levels, added a 50 EMA on here, and I'm just going to look at this trade and look at this double bottom tap position here. So, let's say for example, I personally wouldn't enter the position, but let's just say you were looking at a position around, let's say here, after price pushes, well, let's say you enter a position based on a retest of some level in here, right? So let's say you get involved and you're getting involved with the 30 pip stop. Have you ever been in a situation where price will run maybe 1, 2, 3, 4, 5% in profit, and then if you're not managing risk effectively, can equally come back down and take you out for either a break even or a 1% loss, especially if you're not managing risk effectively. Depending on your upside, it depends on a lot of different factors: strike rate, win rate, your average winner, your average profit factor. Like there's so many different things that come into it. However, from a basic standpoint, you need to protect your capital, your downside. So have you ever had a situation where price will push up into profit and then take you out? I've had it on so many different occasions, so I'm pretty sure all of you, or if not most of you, will have been through the certain thing. So we're taught to put a full position on of maybe 1%, 0.5%, 2%, and then you just let the trade run, and then you move to break even at a certain point, trail your stop below, profit target, etc., etc. However, what about if you split the risk? So essentially what you're doing is, at a certain target, let's call it at this point, as Peter Grant was talking about, let's say a 1% profit, right? Now I'm going to add commissions to that, and we'll call it now 1.3 to be more realistic, because the truth is that when in the game of trading, you get commissions on trades. So let's say 1.3. For me, it's a bit higher, but let's say on average, if we take into consideration the collective of everyone watching this, it's likely going to be around 1.3-ish. So if you take 50% of the trade off, or a good percentage of your trade at 1.3 or 1%, then essentially what you're doing is, worst case scenario after this, let's say price comes back down and takes you out for the loss. Essentially what you've done is you protected both your mental and physical capital. Why? Because you've taken a winning trade, so half of the trade that you've taken off is now a winner, and half is a loser. So you've essentially mitigated out that loss. So you've netted break even. Now, going back to the fact that, it's very likely, this is common stats, it may not be too accurate, it may be quite accurate, I'm not 100% sure, but 90% of traders, lose 90% of their capital in 90 days. I guarantee if a lot of traders just use some sort of metric similar to this, they can save a lot of capital. They can save themselves a lot of stress and protect both their mental and physical capital. So if we're talking about managing risk here, I personally think this is a very good way of managing risk. Now, I personally don't think you should copy it, but almost test it, experiment with it, and put your own twist on things. Think for yourself and put your own twist on things. The downside to this, which I'm going to bring up as well, because there's pros and cons to everything, is that if this trade does run on to bank, let's say you were targeting the swing for 6% in this situation, then you're essentially halving your profit, because half of your profit now has been taken off around this level here, about 1.1, 1.2, 3. So you're essentially halving that profit. But the upside is that you're protecting your risk and you're protecting your downside. And that's important. So something to think about, something to, at least go away. And I urge you to just have an open mind about this. I don't urge you to, come away and apply everything that I've said, but at least have an open mind, at least go back through your trades taken if you track your trades, which you should be doing, by the way. And just look at your trades and just be like, okay, well, if I actually apply this, realistically, how would this have either benefited me or held me back? What difference would this have made? How would the profit and loss look? Would it have too much impact? What would the strike rate be? What would the win rate be? What would the profit factor be? All these different factors. So give it a go for yourself. Let me know how you find it. And I just wanted to point out that important lesson of risk management and managing risk effectively of the funding process so far. So I just got to the gym. I'm about to hit a quick pull workout before getting back home. When I get back home, I'm going to talk you through what my intentions are going forward with trading without revealing my next move too much, because I don't really like doing that, and what I'm brushing up on skill-wise, trading-wise, to improve to the next level. So yeah, I'm going to do the workout and then I'll catch you guys in a bit. Right, so we're now funded, but now what? What's the next goal? What's the next milestone? What am I working on now going forward? So I'm going to share and give you a bit of insight into that without revealing too much of my next move, because I don't believe that's smart to let everyone know your business without actually doing it first. I'd rather do it first and talk about it later, so that's exactly what I'm going to be doing. But what I'm working on right now is effectively I'm practicing a lot. I'm going back through the trades that I've taken, and I'm a very big advocate of the 80-20 rule. And I know in the back of my mind that 20% of my trades equate to 80% of the results. More or less, it's not an exact science of course, but thereabouts. Now the final 80% there's common patterns in there of losing trades and winning trades that aren't going on to do as well maybe. There's just common patterns in there that I'm looking to eradicate and minimize, and those 20% that equate to 80% of the results, those are the ones that I want to double down on, experiment more with, and just make more of a part of my plan to be taking them more regularly. And that's the main thing that I'm working on right now. It takes a lot of practice, it takes a lot of repetition. You can know something up here, but actually applying it is a very, very different story. So that's what I'm working on right now, because I essentially know what I have to do and I'm applying it, but it's a lot harder to apply it. So I feel like just through that repetition, as the weeks go by, I'm getting better and better, the skills getting better, I'm becoming more advanced in both myself, my psychology, my trading ability, my technicals, everything. So just looking to do that, and I'm looking to take that going forward really. So that's what I'm working on right now. I'm just looking to continue improving as the weeks go on, as the days go by, and just get more experience. I'm no longer back testing the same way. I feel like the expiry date has come for the days of going back through data and going back through 3, 6, 12 months of data, studying that price action. I feel like I've gone through that, and it's more of an evolved version now. So what I'm doing is on the weekends, that's when I'll spend my time, and I'll go back through the past week. And because I'm only trading limited pairs right now, it's a little bit easier to study every single little detail on the charts at the time of when I trade, and just learn from that. As it's almost forward testing, and I feel like it's a little bit more efficient than what I used to do. But I had to go through it and I had to learn from it. But longer those days are when I used to go back through 3, 6, 12 months of data. It's a little bit different now, and I feel like everything's just evolved to a certain extent now. So that's what I'm spending my time on really, and just a lot of practice, a lot of studying charts, studying myself. It takes a certain skill to, if you're making common patterns in the market, to take a step back and almost look at things from a third person perspective and just tell yourself what you're doing. So if you do, for example, now this is interesting actually, I haven't planned to talk about this, but one of the things that I'm almost trying to eradicate now is a little bit of tilt. So if you've read Mental Game of Poker, or you're familiar with poker, players can go on tilt. So essentially what tilt is essentially, it's when you spiral out. So you could make a bad decision, or you could get dealt a bad hand, or whatever it may be. Something causes you, or something triggers you to go into a tilt mode of making bad decisions, making bad hands. So the same goes in trading. It's the same can be applied to trading. So I wouldn't say I essentially go on tilt, but I feel like that sometimes creeps in. So when that creeps in, and before it takes place, it's having that tilt profile in place, and just make sure that I can almost stop it and prevent it before it happens. So that's what I'm working on right now. Stopping myself. I would say stopping myself, because it's not really stopping myself. It's almost just how would you say this? Protecting capital, and just knowing when to take a step back from the markets, and like I said, looking at things from a third person perspective. If I'm here at the desk and I'm sat there, it's just me and the charts, almost looking outside of myself from behind and going, cool, what am I doing here, and how can I better myself through that process? So yeah, that's pretty much what I'm working on right now. That's what I've been working on. Going forward, I think, I'm just looking to build scale, and I think you know what that means, but I'm just looking to build scale when the time is right, and not too quick, not too slow. When the opportunity is there, I'll just add more and more and more and more, and it's going to be good. It's going to be a massive year. I'm just looking to continue focusing on myself. I'm off social media for now, not YouTube of course, but Instagram, just cutting out distractions left, right and centre to just focus on myself, because I know it's a massive year. It has been already, to be honest. So yeah, that's pretty much this year, 2021. So that's a roundup of episode 3. Hopefully you've enjoyed it. Hopefully you've enjoyed just the informative points that we covered, especially in the lesson part as well. Something to at least apply, experiment, see if it works for you. If not, cool, nothing lost, but if it does, bonus. So let me know how you get on with that, and yeah, I'm gonna tune out here, but look forward to seeing you in episode 4 coming shortly. So see you soon, have a good rest of the week, and see you soon.